Why is crude oil dropping today? Crude oil peace talk impact. Oil price support level 72. Crude oil weekly forecast. Oil RSI divergence setup. S&P 500 gamma levels influence on crude. Institutional crude oil positioning. WTI breakdown trade plan. Oil supply risk premium collapse. Oil just broke below every daily moving average in one violent push. Overnight, crude cratered another 1%. The headline says peace talks are progressing. The Strait of Hormuz risk premium is getting vacuumed out of the barrel. So now the entire market is leaning short, thinking we're about to freefall to $60. But there's one dangerous blind spot, and it is a trap that crushes late shorts. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. The herd is already positioned. The algos are sniffing liquidity, and if you don't see the invisible rubber band being stretched below the surface, you will get run over. Let's get straight into the instant market verdict. The session bias is strong sell, trending, not a range-bound chop. We are in a high-velocity, one-directional energy flow. ADX is above 41, CCI is buried at -109, and Williams R is pinned at -97. This is not a slow bleed. This is an exhaust pipe opening. However, the market is now probing the first critical support at 72.02, which is the S1 level on the daily pivot. This is the exact number that separates an orderly decline from a liquidity vacuum freefall. Write this number down. If we break and close below 72.02 on the 4-hour candle today, the entire structure resets, and the path to 67.12 opens up like a trapdoor. But if 72.02 holds and we get an intraday reclaim above 75.92, the bearish momentum wave collapses and short covering ignites. Here's the micro insight about where the herd is positioned. Speculative net short positioning in WTI futures just hit multi-month extremes. When everyone is already leaning over the cliff, the smallest headline, maybe a whisper that talks at a snag, can rip price $2 higher in an hour. That is the trap. The market has priced peace, maybe too much peace that I told you 72.02 is the critical invalidation. But I want you to see this level on the chart. That's the floor that is held multiple times on the daily time frame, going back weeks. If you pull up your platform right now, put a horizontal line at 72.02 and another at 75.92, that's the daily pivot. In between, you have a no man's land where algos hunt stops. Now let's go deeper into the technicals, because the moving averages are telling a story that most people haven't even read. We'll start on the weekly and daily and then drill down to the 4-hour and 60-minute, so you see the exact architecture of this dump. On the weekly chart, the trend is a strong sell, no ambiguity. Price sliced below the weekly MA 20 weeks ago and has never looked back. The weekly MACD is in freefall, deepening below zero, and the histogram bars are expanding, not contracting. That means momentum is accelerating to the downside, not decelerating. On the daily, it's even more violent. Price is trading at 72.94, and here's the critical data. The 200-day moving average sits at 79.21, way above. The 50-day is at 88.20. The 100-day at 85.71, the 20-day at 84.12. The sequence is a textbook death cross formation, shorter-term averages below longer-term averages, all sloping down like a staircase into the basement. The price is literally miles beneath all of them. The 200-day moving average is sitting right here, acting like a brick wall overhead. It is the gravitational ceiling that any dead cat bounce will smash into. And notice the RSI on the daily, 28.9, deeply oversold. But do not mistake oversold for a buy signal. In a strong trend, the RSI can sit below 30 for weeks, and every bounce gets sold with fury. The momentum is so extreme that the stochastic is reading 11.5, and the MACD line is at -576, still diving with no bullish crossover in sight. This is the picture of a bear freight train, now dropped to the 4-hour time frame, and here's where it gets interesting for the trap I mentioned. At first glance, the 4-hour is also a strong sell. The price is making lower lows and lower highs, The moving averages are cascading, the 4H MACD is below zero. But look at the RSI on the 4-hour. While price has been carving a new swing low near 72, the RSI has not made a lower low. It is forming a slight higher low. This is a regular bullish divergence in development. Most traders completely miss this because they are hypnotized by the red candles. Here's what most traders miss. When you get a momentum extreme on the daily but a divergence on the 4-hour, it often leads to a sharp mean reversion spike that wrings out the weak shorts before the trend resumes. That is the hidden rubber band. It doesn't mean we turn bullish. It means the next leg down may require a liquidity grab above to fuel it. The 60-minute chart confirms the short-term exhaustion. It's also strong sell, but the candles are beginning to compress near support, and we are seeing smaller bodies. That compression often precedes a violent expansion. So the technicals scream, we are bearish, but the risk of a short squeeze is extremely elevated right here, right now. This hidden divergence on the 4-hour is the pivot point of my entire analysis. Most traders are piling into shorts at the lows, chasing the trend, while the algorithm is preparing to yank price back to a key resistance level to find new sellers. The level that matters is 75.92, the daily pivot, and overlapping with the MA5 at 75.51. That zone, 75.50 to 76, is where the mean reversion mirage would exhaust itself if the trend is still healthy. If price spikes into that zone and then shows a rejection, it is the ultimate short entry opportunity. Conversely, if price breaks above 76.92, R1, the divergence wins and the trend flips neutral, possibly even bullish for a swing. That's the line in the sand. Now let's connect this technical architecture to the fundamental driver that lit the fuse today. The 24-hour core news is the only thing anyone is talking about. Oil prices finished 1% lower as investors focus on Hormuz flows after peace talks progress. The Strait of Hormuz risk premium has been evaporating. Remember, crude has been carrying a war premium for months. Whenever there was a supply disruption threat, the bid came in. Now, with peace talks gaining traction, the market is starting to price a normalization of tanker flows and maybe even the eventual easing of sanctions. Yesterday's ECB speaker may have moved the euro, but for oil, the only narrative is the geopolitical heartbeat. Peace equals supply relief equals prices lower. The analyst articles and sell-side sentiment is uniformly bearish, reinforcing the trend. But here's where the cross-linkage gets deadly. As oil dumps, it drags down energy equities, which weighs on the S&P 500. In turn, a risk-off equity move strengthens the dollar, and a stronger dollar adds more pressure to commodities. It becomes a negative feedback loop. The dollar index is grinding higher, real yields are sticky, and that is a bearish cocktail for any commodity priced in dollars. Furthermore, we are seeing ETF outflows from crude oil funds accelerate, confirming that speculative hot money is fleeing the long side. So the 1 to 2 week directional lean is further downside towards 70 and then 67, barring a peace talk breakdown. The exact event that invalidates this bearish lean is a daily close above 76.92. If that happens, the narrative flips to peace premium priced in, time to squeeze. Do you think oil breaks $70 this week? Comment yes or no right now. I'm tracking consensus and I'll reference it in tomorrow's video. Before we move into the 3 trade setups, I need to say this. Most people click away right here. That's exactly where the money is made. Keep watching. I'm about to hand you the exact sniper levels, stops, and risk-reward ratios that you can take straight to your platform. Every single setup includes the on-screen trade plan graphic so you can screenshot it. The market doesn't reward the lazy, it rewards the prepared. Strategy number 1, the sniper, conservative. This is for the trader who waits for the optimal risk-reward entry on the side of the dominant trend. We want to short oil, but not at the lows. We want to sell into a bounce, into that rubber band snap. The exact trigger condition is a 1-hour candle close below 75.50 after price rallies into the 75.50 to 7600 zone. Why that zone? Because it's the confluence of the daily MA5 and the daily pivot. It's where the short covering rally is most likely to run out of gas. So you wait. No chasing. If price rips up and then a 1-hour candle closes below 75.50, that rejection is your signal. The stop loss goes above the invalidation level at 77 even, just above the R1 daily resistance at 76.92, giving a small buffer. That's your hard stop, non-negotiable. Target 1 is 72.02, the immediate daily support we've been obsessing over. Target 2 is 70.18, the S2 level, where the next liquidity pool sits. Risk-reward on target 1 is 1 to 2.3. On target 2 it expands to 1 to 3.5. The setup is void completely if the daily candle closes above 76.92. That means the sellers lost control. On-screen trade plan graphic, the sniper, conservative entry, 75.50, 1H close below, stop loss, 77.00, take profit 1, 72.02, take profit 2, 70.18, risk, reward, 1 minute and 2.3 seconds, 1 minute and 3.5 seconds, invalidation, void if daily close above 76.92. Screenshot that. Strategy number 2, the active trader, standard. This one is for those who want to ride the momentum breakdown if 72.02 gives way. You're not fading the move. You're joining the flow with a clear trigger. The entry condition is a 15-minute candle close below 72.02, confirming the breakdown. That level is the floor. Once it shatters, liquidity cascades. The stop loss goes at 73.20, just above the recent intraday consolidation high. That stop is tight enough to keep risk small but wide enough to avoid noise. Target 1 is 70.18, the S2 support, which will act as a magnet. Target 2 is 67.12, the S3 level and the next major demand zone. The risk-reward on this play is asymmetric. Risk to target 1 is about 1 to 1.6, but to target 2 it skyrockets to 1 to 4.2. Once target 1 is hit, trail your stop to entry to create a risk-free runner towards 67. The setup is invalidated if price recovers back above 73.20, signaling a failed breakdown and a possible trap for breakout sellers. Type your crude oil range for tomorrow in the comments now. Give me a high and a low. I want to see who is aligned with these key levels. On-screen trade plan graphic, the active trader, standard entry, 72.02, 15-minute close below, stop loss, 73.20, take profit 1, 70.18, take profit 2, 67.12, risk, reward, 1 minute and 1.6 seconds, 1 minute and 4.2 seconds, invalidation, void if price reclaims 73.20. Strategy number 3, the aggressor, high risk. This is the countertrend bounce play that exploits that hidden 4-hour bullish divergence. This is not for everyone. Only take this if you can lose small and you want to buy the extreme fear. The entry is a limit. Order at 70.20, relying on the S2 support at 70.18 to provide a floor. You need confirmation of a bullish engulfing candle on the 15-minute chart before pulling the trigger. No confirmation, no trade. The stop loss goes at 69.80, just below the S2 pivot, giving a 20-cent sliver of risk. That's an extremely tight stop, but that's the point. You're scalping a reaction. Target 1 is 72.02, the broken support that will flip to resistance. Target 2 is 73.50, near the breakdown area. The risk-reward is staggering. Target 1 offers 1 to 4.5, Target 2 jumps to 1 to 8.2. But the probability is lower. If the market gaps through 70.18, do not chase. If the daily candle closes below 69.80, the pattern is dead and the freefall is accelerating. Warning: this is a countertrend trade. You must use precise position sizing and zero hesitation on the stop. On-screen trade plan graphic, the aggressor, high-risk entry, 70.20, bullish engulfing 15 minutes, stop loss, 69.80, take profit 1, 72.02, take profit 2, 73.50, risk and reward, 1 minute and 4.5 seconds or 1 minute and 8.2 seconds, invalidation, void if daily close below 69.80. We've just laid out 3 fully actionable trade plans with exact levels, covering the trend continuation, the breakdown momentum, and the countertrend bounce. Every single one is defined by a number and a condition. That is how you eliminate emotion and trade like an institution. Now, rapid-fire risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news events. Stops are non-negotiable. This is how you survive to trade the next big move. Crude oil is a beast that can gap $2 on a single headline. Position size accordingly. If you're new, stick to the sniper setup. Do not try to be a hero with the aggressor unless you fully accept that loss is part of the math. Protect your capital, and the profits take care of themselves. As we wrap, the single most critical level for the next session is 72.02. If it holds, we likely get a short covering bounce into the 75.50 zone. If it breaks with conviction, the path to 70 and then 67 opens with frightening speed. The price action around that number will dictate the entire risk tone in energy markets. Tomorrow's wildcard is any fresh headline out of the peace negotiations and the weekly EIA inventory data that could add a demand-side shock if we see a massive build. That combination could be the catalyst for the next leg down or the reversal trap. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. I unpack the liquidity tied inequities and the risk asset shadow in crypto. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Trade smart, stay disciplined, and let the chart be your only narrative.